Hello, investors and traders, and welcome to the weekly market report with the market guys. I'm AJ Monty. This is a one-year daily candle chart of the S&P 500 ETF, ticker symbol SPY, also known as the spiders. And as I zoom in here, you'll see that this line, this diagonal line, was my forecast from last week. And again, if you're new to the market, guys, understand that I leave my lines on the chart so you can see the evidence with your own eyes as to how well the technical charts, particularly candle charts, work as a forecasting tool. So I said that early in the week we would most likely go up and hit the target. Now on Tuesday we dropped and then proceeded to continue on its upward leg. And today, like clockwork, we hit my target, which is the end of that line right there. So what does that mean for next week? Well, if you look down at the bottom of the chart, you'll see this is the stochastics oscillator. I think that the stochastics will continue to move higher, showing some upward momentum. However, this candle, which is an inverted hammer, is fairly bearish for the short term. So we have some resistance right here at this bearish engulfing pattern that I think we will test. So I'm going to say we're going to move up just a hair on Monday and or Tuesday. And then I think we're going to pull back to fill this downside gap right there. Now, if you go to the Market Guys website and click on the video tab, you'll see that there's a video in there called Gap Trading. And if you watch that, it's only about 7 minutes long, you'll know that there are certain rules that we follow when we're trading the gaps as a strategy. First rule is that 80% of the time, gaps fill. Now, the other half of that rule is once the gap fills, again, I think that will happen, 80% of the time after the gap fills, prices reverse and go the other way. Now, I think it's still too early to tell whether or not that's going to happen. We'll have to maybe make that forecast next week. But I think there's a good chance that that gap will fill. Now, if we look at the VIX, which is inversely related to the S&P, and I zoom in, you'll see that my forecast was that we would move lower and then we would bounce. Now, I'm going to leave this in place. In fact, what I might do is just extend this for next week. I think that the VIX will then bounce at this area. We hit my target. And you'll notice, again, I'll zoom in here with the magnifying glass. Right there, there is a minor gap on the VIX that's above the market. Now, this is a one-day gap. The market opened higher, so the VIX dropped. So this gap fill right here will be a price target. And I think that that is a good chance that that will fill. And if you, again, been following my gaps on the VIX, I tell you that 100% of the time gaps fill. I am most certain that that gap will one day fill. Whether it be next week, we don't know, but there's a good chance that that will happen. So that's for the VIX. As we hop to the Qs, ticker symbol QQQ, we are looking more or less at the NASDAQ market, and we hit my target pivot point right here. I said we would move up and then start to pull back. So I'm going to leave this in place right here and maybe even extend that just a little bit lower, just like that. And this is an inverted hammer. There's a gap below the market that will act as a price magnet. I will now make a forecast on the CCI. I think the CCI will start to drop probably midweek next week. We have options expiration for the monthlies on Friday. So we'll see how that affects the markets. But overall, we could go a little bit higher. But in the end, I think, towards the end of next week, I think we'll wind up a little bit lower than we are now. Again, assuming no tweets, no big bad news, no big good news from China. It doesn't matter. I think investors are getting a little tired of the up and down movement as knee-jerk reaction to the news, both positive and negative. I don't want to make fun of any of the sheeple out there, but I think it's time for investors to look at value and not get so emotional about what's going on between the U.S. and China trade deal. So that's the Qs. Now, if I hop to a more broad-based index in the Russell 2000, we'll see that we have the target is the end of this line. I think the Russell 2000 will still go higher. It doesn't necessarily move in line with the Dow or the Qs or even the SPY. I think that we could move higher right there, and I'm going to leave that in place. And then finally, the diamonds. We hit that right here. We hit the price target. There's a gap below the market. I think that the diamonds are going to go just a little bit higher on Monday and then start to pull back in an effort to fill this gap. And it doesn't look like much on the chart right here. I'm going to erase this line to the bottom. Doesn't look like much on the chart, but again, we were up at one point, we were up almost 500 points. So these small, maybe what some might say insignificant gap to the downside there, that could very well be a big downward move as we pull back to fill the gap. Now, last week I analyzed OUSA, which is Kevin O'Leary's O shares. Had a chance to talk with Kevin about this. I told him that there's a very good chance that we could see record highs in this pretty soon. That was because of the weekly chart that I was analyzing last week. And you can see that we have a hammer pattern this week on the weekly that is also a bullish engulfing hammer. You see this? So last week we had a hammer pattern. This week we have a hammer pattern. I think the O shares could actually go higher because this is a high dividend ETF, and some of the holdings in this are Apple, Verizon, Home Depot. So I think this one could continue higher with some resistance up here just over 35. If it starts breaking out over 35, we'll probably change our tune just a little bit to get a little bit more bullish, but there's still a gap down here that could fill. But overall, I think next week OUSA could go higher, especially as some of these stocks start declaring their dividends. Ford was one that declared a 15-cent dividend yesterday. So, investors are coming in, they're wise. They want to be able to invest in something that's going to give them a good return. And the high yield dividend stocks are a safer way, I should say, for investors that are trying to muscle through this volatility. So that's it. Make sure you visit themarketguides.com, look at some of the videos, and we'll talk to you soon. Have a good weekend. Bye-bye.
This video segment is a small part of what the Market Guys offer through their educational products and services. If you are interested in any of our trade alert services, or you would like more information about our one-on-one mentoring program, simply contact us at info@themarketguys.com.